Hello everyone. In this video, we shall discuss the concept of government securities. What is a government security? What is a bond? What is a treasury bill? What is GSEC? Different types of treasury bills, different types of bonds. Who buys the bond? Where is this bond uh, bought and sold? Who is involved in this? So all these things we shall discuss in this video. Now, first of all, we should know what is a bond. Bond is a debt instrument in which an investor loans money to an entity which borrows the funds for a defined period of a time at a variable or fixed interest rate. So basically, bond is an instrument where somebody gives loan to somebody else for a fixed period of time and at a fixed rate of interest. So this is simple. It's an instrument through which somebody gives loan to somebody at a fixed rate of interest and it has a fixed time period. So it could be it could be given by a corporate sector or it could be given by the government. So bonds are used by companies, municipalities, and then the state government, then the national government, which is basically a sovereign government, to raise money to finance different varieties of projects or activities. So when government basically borrows from the public, they borrow money through the government bonds. By selling government bonds, they can mobilize the money. And so the owner of the bonds are called as the debt holders or the creditors. You are basically holding. Now if government is selling the bond, then government is the issuer. Okay? The owner of the bonds are the debt holders or the creditors of the issuer. So government is issuing the bond, and the person who is giving the loan to the government is basically the creditor. And what is a government security? In newspaper we read this as GSEC. This is a short term used for the government securities. And what is a government security? Government security or a GSEC is a tradable instrument issued by the central government or the state governments, and it acknowledges the government's debt obligation. So, and it could be short term in nature or it could be long term in nature. And when we say a government security is short term in nature, this is called as a treasury bill, which has the original maturity period less than 1 year. So remember, government treasury bills are usually short term in nature, and when it is called as a treasury bill, then we call this as a short term government security, and its maturity period is less than 1 year. And then government security could be long term in nature, and when it is government security is long term in nature, then this is called as a bond, okay, or a dated security, and it has a maturity period of more than 1 year. So treasury bills are short term in nature, this has maturity period less than 1 year, and bonds are long term in nature, and that is the basic difference between these two, bond and a treasury bill, and both are government securities. Now in India, the central government issues both treasury bills and bonds or debtor securities, but the state governments issue only the bonds or debtor securities, which are also called as the state development loans (SDLs). So state governments do not issue short-term bonds, short-term government securities, or we can say that the state governments do not issue treasury bills. It is only the government of India which issues treasury bills. But on the other hand, the state governments issue only bonds which are long-term in nature. These are also called as the state development loans or SDLs. And since government securities or GSECs are not risky at all, because usually the government never fails, or government never says no to service the debt. So these are basically known as the risk-free, gilt-edged instrument. Okay, all these government securities are known as risk-free, gilt-edged instruments. Now, what is a treasury bill? Treasury bill, I told you that treasury bills are short-term government securities, and this maturity period is less than 1 year. So this is an abbreviation or short-term form people use as T-bills, which are basically the money market instruments and are short-term debt instruments used by the government of India. So it has basically three tenors. One is 91 days. These are basically multiples of 7, and one is 91 day treasury bill. Other one is 182 day treasury bill, and then third one is 364 day treasury bill. So all these treasury bills are short-term nature and they have a maturity period less than 1 year. And treasury bills are zero coupon securities and pay no interest. So treasury bills do not give any interest, rather they are discounted on the face value. And we can take an example. Suppose a treasury value worth 100 rupees is sold in the market, then the buyer, so the face value of the treasury bill is 100 rupees, but then the buyer will buy it at 98.20 paise. So that means there is a discount of 1 rupee 80 paise, and when the treasury bill matures, the buyer will get 100 rupees. So you are buying the treasury bill at 98.2 rupees and you are selling it at 100 rupees, so you get the value of 100 rupees. So the benefit that you get is 1 rupee 80 paise over a short period. It could be say 91 days, and that's how basically you make money out of this. And the return to the investor is the difference between the maturity value and the face value, that is basically 1 rupee 80 paise. Then another type of bills are available in the market. Those are known as cash management bills. And for the first time in 2010, Government of India, in consultation with the Reserve Bank of India, introduced this short-term instrument, which is known as the cash management bill. And the objective behind introducing this kind of bill was basically to meet the temporary mismatches in the cash flow of the government of India. Sometimes there will be more cash, sometimes there will be less cash. So you can use these kind of bills to manage the cash, and so in 2010 this was introduced. And so this is cash management bills are of type treasury bills type characteristics, and they are issued for less than 91 days. So these are, you can say, short-term treasury bills. And then we have dated GSEC or government securities. And dated government securities are basically the securities which carry a fixed or floating coupon. Coupon here is basically interest rate. So dated securities are basically relatively long term in nature, and they carry a fixed or floating rate of interest or coupon, which is paid on the face value on half yearly basis. So every government treasury bills, when these are long term, sorry, the government bonds, the yield or the coupon is basically paid twice in a year. And generally the tenor of the dated securities range from 5 to 40 years. So these are very long term in nature. When it is 40 years, it is quite long term in nature. And it is the public debt office of the Reserve Bank of India acts as a registry or the depository of government securities and deals with the issue, interest payment and repayment of the principal at maturity. So basically, no, government finance minister does not go to the market directly. It is the Reserve Bank, which is the banker of the government of India as well as the banker of the state governments, does everything for the government. It mobilizes the money for the government of India. And most of the dated securities, which are long-term in nature, are having fixed coupon securities, or you can say fixed interest rate. Because since these are long-term in nature, if we give them floating interest, then many people will be uncertain. And because whenever there is a floating interest rate, there is a very high chance that in the long term the interest rate will always fall. And if you are buying a dated security or for say 30 years or 40 years, you would not expect to get lower rate of interest. That is why government assures a high rate of interest and it gives a fixed coupon security. So, in a typical government security, the following information are given. First, the coupon rate is given, that is the interest rate 7.17 percentage on the face value, and then name of the issuer, whether it is Government of India or it is government of state government issuing, with the long-term in nature, on which date this is issued, on which day this is going to mature, and the coupon payment dates, basically the twice in a year, half yearly, on July 8th and January 8th, these are paid, and the minimum amount, basically the face value of the coupon that is sold. So these informations are provided in a typical government security. Now, the nomenclature of another typical rated government security could be that suppose there are two securities with the same coupon value and are maturing in the same year. Okay, so, same coupon value interest rate, and it is maturing the same year. In that case, uh, in one of the securities will have the month attached as suffix. For example, if the government issues one government security with 6.05% interest rate, and it matures in 2019, so basically it will be written as 6.05% GS 2019 February. It would mean that it is a government security which has a coupon value of or interest rate of 6.05%, and this will mature in 2019 February. And similarly, you can also have other names under other rate of interest. So in this case, there is another paper which will have 6.05% government security and in matures 2019. So if it is maturing in the month of June, then in place of February, we will be writing June. The other things remain constant if the maturity year and the rate and the coupon rate remains constant. And each security is assigned with one unique number called ISIN, that is International Security Identification Number, and at the time of issuance itself, to avoid any misunderstanding among the traders. So, unique number is given as a security number. Then we have different types of bonds. We have fixed rate bonds, then we have floating rate bonds, then floating rate bonds could be very, also different. So we shall discuss what is fixed rate bond. These are basically the bonds on which the coupon rate is fixed for the entire life. So that means suppose we take we buy a bond, and then the fixed rate of interest is mentioned 8% interest rate. Then government will have to pay the fixed rate of interest. Then floating interest rate, basically nowadays when we take a housing loan, we basically get it on the floating rate of interest. That means interest will always, so you have to pay the interest at the rate of interest which prevails on the day of repayment. So if you have to pay the interest rate today, then we will look at the market rate of interest. If it is higher, we will have to pay higher rate of interest. If it is lower, we will have to pay lower rate of interest. But usually in a developed country or in a developed banking sector or in a developed economy, the rate of interest always falls. So you can see that trend in India also. So floating rate of when we say the second type of bond, that is floating rate bonds, then these are basically the securities which do not have a fixed coupon rate or interest rate. Instead, it has a variable coupon rate or interest rate, and which is reset at pre-announced intervals, say every 6 months. So at every 6 month interval, when somebody will have to get the rate of interest, you will be getting it as per the market rate of interest that is prevailing on that particular day, that is July 8th or January 8th. And the floating rate bond can also carry the coupon which will have the base rate plus a fixed spread. That means there are also different type of floating rate bonds. One is that some minimum coupon is interest or minimum interest is assured, then plus and minus. Other than that gives you some certainty that okay, I will get minimum this much of rate of interest, and it could be a little higher or it could be a little lower than this. And so the spread will be fixed throughout the tenure of the bond. And then comes capital indexed bond. So these are the bonds, the principal of which is linked to an accepted index of inflation with a view to protecting the principal amount. So basically, the principal amount is also linked to rate of inflation. And that's a good thing because you will be getting higher value from that, because if you have bought a bond worth 1 lakh rupee then due to inflation, you may lose the value of your bond because of the inflation, even though you are getting rate of interest. So government has also designed a different type of bond, which is known as capital index bond, where the principal amount is linked to an accepted index of inflation, and so that your principal amount remains protected from the inflation. And a 5-year capital index bond was first issued in the year December 1997, which matured in 2002. And then we also have inflation index bonds. These are a little different from the capital index bond. In inflation index bonds, here both the principal amount and the coupon flow or the interest flow are protected from the rate of interest, because sometimes remember, when inflation rate is higher than the rate of interest or the coupon rate that you are getting, that means you are incurring loss, because you could have gained if you had bought the money, if you had bought commodities and stored it. So if you are doing some investment, your rate of return from that investment should be higher, and that is why it is always wise to basically index your principal amount as well as your rate of interest against some rate of inflation, and to measure the inflation. Basically, in India, we are using the consumer price index, but both wholesale price index and consumer price index can be used. But in India, it is the consumer price index which is basically indexed to the inflation bonds. So that is the basic difference. Then comes the bonds with call or put option. The people who are dealing with the share market will be a little familiar with the concept called and put options. And then bonds can also be issued with features of optionality, wherein the issuer can have the option to buy back, or the investor can have the option to sell the bond, to the issuer. So both parties can either the issuer can buy back, or the investor can also sell the bond to the issuer during the currency of the bond. And it may be noted that such bonds may have put. So some bonds will have only the put option, and some other bond will have only the call option. Now there are also special securities under the market borrowing program. Government of India also issues special securities from time to time. And in India, we have oil marketing companies, we have fertilizer companies, Food Corporation of India. They basically issue special securities, popularly known as oil bonds, fertilizer bonds, food bonds, and these are basically given as the compensation to this company in lieu of the cash subsidies. Government will give them financial support through these oil bonds, fertilizer bonds, or food bonds, so that they can encash this and get the money. And these securities are usually long dated securities and carry marginally higher coupon over the yield uh, of the dated securities and comparable maturity. These securities are basically, however, not eligible for the statutory liquidity securities, but are eligible as the collateral for the market repo. Remember, when one company, basically when one bank, basically all these bonds and treasury bills are bought by the banking sector or the financial institutions, big financial institutions, and they can suppose when some of the bonds are long term in nature and sometimes they need money, they can always sell it in the market to somebody else. And so that provision, and similarly this can also be used as statutory liquidity provision, but then special securities are not cannot be used for this purpose, for a statutory liquidity purpose, but they can be used as collateral for the market repo transaction. And similarly, the beneficiary entities may divest these securities in the secondary market to banks, insurance companies, and primary dealers for raising funds. So these are liquidity enough. Whenever they need money, they can always the oil companies or the fertilizer companies or Food Corporation of India, they can always liquidate this for getting the currency. Then comes other type of bond that is called as separate trading of registered interest and principal of securities, what is basically known as stripes. And stripes are the securities created by a way of separating the cash flow associated with a regular government security. And each semi-annual coupon payment, and the final principal amount to be received from the issuer in separate securities. So they are essentially the zero coupon bonds, and they are created out of existing securities only, and unlike other securities. And striped securities represent future cash flow of any underlying coupon bearing the bond. And then comes the sovereign gold bond, which is launched very recently, and the gold bonds are unique instruments, and there are something, I think it is typed wrongly, that okay, some of these SGB, these are basically the sovereign gold bonds, are basically the unique instruments, and the prices of which are linked to commodity price, that is gold. And the sovereign gold bonds are also budgeted in lieu of market borrowing. Government announces in the budget, and then the calendar of issuance is published, indicating trends of description, and it bond will be usually denominated in units of 1 gram of gold and multiples thereof. So you can buy, any gold, sovereign gold bond of 1 gram or multiple of that, but there is a limit. For individuals, you can buy in a fiscal year up to 4 kg for a Hindu divided family, and 20 kg for the trust or similar entities. They can also buy a trust. Another entity can buy this gold bond, sovereign gold bond up to 20 kg, and these are repayable on the expiry of 10 to 8 years from the date of issue of the bonds, and premature redemption of these bonds are also possible only after the fifth year of the date of the issue. So it is little bit illiquid, because before 5 years you cannot encash this, but after 5 years you can always encash the sovereign gold bond. And then so how this is bought and sold? These are basically the issue price of the gold bonds will be 50 rupees per gram less than the nominal value to those investors applying online, and the payment against the application is made through digital mode. So basically, you buy this at a little lesser price than the nominal value of these investors, and the bonds will bear the interest rate of 2.5%. It is fixed per annum, and remember, this sovereign gold bonds basically give return from both sides. It gives you a lower rate of interest, that is 2.50, but at the same time, you will be getting the market price of the gold, and interest you will be getting every half yearly. And when you want to redeem, basically redeem the cash at when you want to sell the sovereign gold bond, you will be getting it. How it is done? The redemption price shall be based on the simple average of the closing price of gold of 999 purity of previous 3 business days from the day of repayment. Suppose you are now willing, you have bought a sovereign gold bond, suppose 8 years ago, and you want to now encash it. Now, if you want to encash it today, then from today, before today 3 years, we will be taking the market price, and we will be taking the average of that, because gold price fluctuates every day. So we'll be taking the average price of last 3 days, and that is basically published by the Indian Bullion and Jewelers Association Limited. So that price will be given to you. So that means you get a higher price for the gold, and gold prices, if you look at the past, the prices have always come, and at the same time, you also get a 2.5% interest on this. And so this is how gold bonds function. And then there is another type of bond which is known as a saving bond. This is 7.75 saving taxable bonds. 2000. This was launched in the year 2018, and Government of India decided to issue this 7.75 saving, but these are taxable bonds from the year 2018. People can buy it from the market also. And then coming to so these are the bonds that we discussed, that these are for the Government of India. Now the state governments also can raise loans by selling bonds, and we discussed that State governments can issue only the long-term government securities, which are known as bonds or dated securities, or these are known as the state development loans. And state governments can also issue these long-term bonds. And so basically, all the state governments come in with an agreement with the RBI to do the transactions on behalf of the state governments. Now, in a couple of years ago, the Jammu Kashmir government did not have such agreement with the RBI. They had their own bank. Similarly, Sikkim also does not have such agreement with the government of India. They have their own provision. But rest of the states have their agreement with the RBI, and that's why RBI does transaction or mobilizes money for the state governments. And so these are also auctioned in the market, and then there's also inter-service half yearly, so almost like the government bond. And state governments have also issued special security like Ujjwala, Discom, Assurance Yojana, scheme for operational financial turnaround of the power distribution companies notified by the Minister of Power. So state governments, similarly local governments can also mobilize money through such mechanism. Then comes government securities. These are basically the large financial institutions or investors can invest in the government securities market. Then our smaller entities such as cooperative banks, then small pension provident fund, they can also invest. LIC, such big non-banking financial intermediaries can also invest in government securities. And there are such agencies are basically mandated to invest in the government securities through the Reserve Bank regulation. Every bank or financial institution is basically mandated to invest certain amount of money in the Treasury Bills, and these are basically the government securities. And then how they are issued in the market. Basically, there is an online platform called eKuber, and this is a core banking solution where the commercial banks, then the scheduled urban cooperative banks, primary dealers, and then insurance companies and provident funds, and whoever maintains a fund account and security account with RBI, they can participate in this online electronic platform where the auction is done. And so they will have to bid in this platform, and the result of the are published on stipulated day and time at basically most of the treasury bills at 1:30 p.m. and for government of India data securities it is 2 p.m. or half hourly interval thereafter in the case of delay. And but the non-Kuber members, including the non-scheduled urban corporate banks, can also participate in the primary auction through scheduled commercial banks or primary dealers. And basically, these are the dealers who participate online and do the auctioning. And RBI, in consultation with the Government of India, issues an indicative half-yearly notification when and which day and at what amount, at what tenure, all these government securities will be issued, so that different parties will be ready to participate in this auction. So press communication is already sent well in advance, so that everybody is aware of this. And not everybody, so these are basically the financial agencies, big financial agencies, they should be aware of this thing. And then the Reserve Bank of India conducts this auction usually every Wednesday to issue treasury bill of 91 days, 182 days, and 64 days of tenure every Wednesday. And settlement of treasury bills auction is made on T plus 1 days. That means today if you are doing settlement, within 1 day plus 1 day, the settlements will be done. So next day of the trade. And the Reserve Bank releases a quarterly calendar of treasury bill issuance for the upcoming quarter, how and when this will be, treasury bills issued. So everybody is aware of this thing. And so through these are done in the website of RBI through a press release. And then comes how is this auction done? These are basically two type of auctions we can say. One is yield based auction, and then other is price based auction. Now coming to the yield based auction, it is basically generally conducted when a new government security is issued. Investors will have to bid in yield terms up to 2 decimal places. So that means basically yield is basically the interest rate, and you will be basically discussing, you will be basically bidding at what rate you will be basically buying this. and basically these are done in the ascending order, like 8.19 and 8.20, and the cutoff yield is arrived at the yield corresponding to the notified amount of the auction. And so on ascending order, basically this auction is done, and you can quote a higher yield, and then any bid that are higher than, which are higher than the cutoff yields are always rejected. So when you are buying a yield, when you are buying a government security, at minimum rate of interest, you will be able to buy the government security. That actually you will have to decide. So if you are putting a higher yield, then it will be rejected. Now coming to price based auction, these are basically done in a descending order. Bids are done in a descending order. So bidders will have to quote in the price of 100 rupees on the face value of the security, the like 100 to 101 and 100 rupees, 91 rupees, 99 rupees for 100 rupees. So that means at what price you will be able to buy, whether it is, if the face value is 100 rupees, whether you will be able to, you will be willing to buy it at 102 rupees, or you will be buying it at 99 rupees. And that's why bids are arranged in the descending order, and if bids are below the cutoff price, then these are rejected. Okay, so you have to, if you are putting a lower price, then you'll basically rejected. So there is a cutoff price. If somebody bids below this, is basically is rejected. Okay, and that means the face value of this should not go below a limit. So here you are talking about the price, and the yield also could be based on the interest rate at what price you want to buy. And so if you see the difference between the yield based auction and the price based auction, then we see that in both cases we have maturity value. Then in case of coupon, in case of a yield based auction, the coupon rate, it is determined in the auction, and that is what is mentioned here. So it is determined here. But in case of price based auction, the coupon rate is fixed, that is 8.22 or something, actually fixed. So in case of yield, then other two things are there. Auction date and maturity dates are mentioned here, and notified amount is also mentioned. But in case of yield, so here coupon, the yield is determined on the auction, and in case of price based auction, the price is determined on the auction. And on January 9th and 10th, being holiday, Saturday, Sunday, basically the settlements are done basically T+1 day. And then comes, yeah, so the specimen of a government security, and this is how it looks like, a stock certificate, and that's all about our government securities. So thank you very much for watching this.